welcome to the first episode of Mastering Futures and Options. I am Anusha Banerjee, and joining me today is Amardeep Singh, Senior Vice President, Angel One Research. Now, in the first episode, apart from delving into the basics of option trading, we will also be demystifying some of the popular futures and options myth that will enable you to make better and informed decisions. So, whether you are new to trading or looking to enhance your knowledge, this series will focus on valuable insights and practical tips. Now, maybe let's start by talking about the history of derivatives market and how derivatives trading started in India on the exchanges.
I would say that derivatives market is a very interesting area and it has become very popular over the last couple of decades. So if I go back in time, so in the 17th century in Japan it all started, wherein there was this rice futures trading which happened, and then post that we had the Chicago Board of Exchange in the 18th century, and even in India if you look at in history, so in 1875 we had the cotton futures which was traded. So derivatives has a very rich history, and it's primarily meant for price discovery and for hedging. But over the last few years in particular, we've seen it explode like anything in terms of the trading. In India, if I look at it in recent times, in 2000 we had the index futures and options come into play, and since then we've seen derivatives really pick up, and we've seen some of the largest volumes happening on the Indian exchanges. So derivatives has really seen remarkable growth because of the different diverse market participants which have come into play, and also because of the different types of risks which have emerged in the markets.
So if you could tell us what are the types of instruments available for trading derivatives?
I would say with the complexity that has increased in the markets, derivatives have also come a long way. But primarily if you look at it, there are four types of derivative instruments. One is the forwards contract, then we've got the futures contracts, then we've got the option contracts, and then we've got something called swaps. So talking about the first one, that is a forwards contract. So that is basically a contract between two parties. So, and that is also called the OTC, means over the counter product. So wherein you don't have counter guarantee, there is no regulator in that. It is more customized in nature. So it is for those players who are in agreement with each other, who've been knowing each other very well, but at the same time they don't have any regulatory mechanism per se. But that's very prevalent amongst different players across the globe. So that's the first one, the forwards contract. The futures and the options contracts, these are regulated contracts, and they are traded on exchanges, and they are regulated by regulators are there. Like in India we have SEBI, which is a regulator for the markets, Indian capital markets. In the US you have the SEC. So futures contracts, again, they are derivative instruments wherein they have their own expiry dates, and one can either hedge using the futures contracts, which is primarily the main purpose for that. Apart from that, the next type of instrument is the options contract. So options contracts are also very useful for hedging purpose, and also for I would say for trading purpose as well. So corporates and all that who want to hedge their risk, be it in commodities like crude oil, or for example in currencies like the US dollar, so they can use these options and futures to hedge. And as these are exchange traded, so these are standardized contracts, and they have their own contract specifications, and it's very popular around the world. And the last one is called swaps, so which are basically between again two parties wherein they exchange. So it could be interest rate swaps, it could be I would say the principal, which could include also the principal. So this again is a type of instrument which is used by few of the players, not by many market participants. So these are the primarily four categories. Amongst them, futures and options are the most popular around the world.
All right, let's start from futures, maybe what they are and what are the benefits that can be derived from trading. Also, if you can maybe talk to us about the risks involved in futures trading.
So first I'll talk about the futures, because futures are I would say very popular derivative instruments. And in the markets, you've got two types of market participants primarily, majorly. One is the hedger, who wants to transfer the risk, and the second is a speculator who's willing to accept the risk. So futures gives you the opportunity that if you're bullish on the market, you can go long futures. If you're bearish on the market, you can go short futures. Means you can sell futures. But at the same time, what happens in futures is that futures, since these are derivative instruments, they are traded on margin. So you have to pay a margin. It could vary anywhere between 8 to 10% to maybe 15-20%. But still, that's comparatively quite less as compared to the entire notional value of the futures contract. So what happens in futures is that, suppose, for example, there are jewelers, there are gold mining companies, so they want to hedge their gold, so they'll use futures on the exchanges. Then you've got your exporters, importers who are impacted by the currency movements, so they hedge on the currency platforms. Then you've got the FIIs, you've got the hedge funds, those who are trading into the futures and options. So they hedge using futures. So futures is a hedging instrument. At the same time, it helps in effective price discovery because you've got so many types of market participants who come in. So it helps in efficient price discovery. And the best part is that futures are instruments which are very popular. Comparatively, they are quite simpler as compared to the options. And these are standardized contracts which are traded on the exchanges. So they are very well regulated. So it's easy and comfortable for all types of market participants. So the advantage is that you have a hedging opportunity, but at the same time, futures, those who are into futures either for hedging or for trading, they need to understand the risks associated with it because these are leverage instruments, so they can cut either ways. So if you're hedging, then it's more or less there's something called M2M, mark to market. So mark to market is that if you are in profit, your account gets credited. If you're in loss, it gets debited, and that happens on a daily basis. So clearly, it means is that you have to have sufficient funds to have positions in futures, and at the same time, you have to understand risk management, money management if you're trading in futures. But it's very exciting, interesting, at the same time rewarding for those who understand and those who manage the risk.
All right, that's a very nice recap on futures. Similarly, maybe you can explain to our viewers what are options and if you can elaborate on the benefits and risks involved.
So options have really spread significantly across the globe because options are also very popular derivative instruments. And at the same time, one needs to understand is that futures are comparatively quite simple as compared to options. So options are also again hedging tools. They are used by, I would say, all sorts of market participants from hedgers to speculators. So I would say the FIIs, I would say DIIs, the hedge funds, then retail. So everyone is into options. But options, one needs to understand is that options is more complex. And at the same time, you've got options. So there's something called option Greeks. You've got called option theta, delta, and there are other option Greeks which are there. So what happens is that options appear simple, but they're not very simple. So what you need to understand here is that options are decaying instruments. So they have something called theta. So the time value of option keeps on decaying. So what happens is that majority of the people who trade options, they trade as if they are trading the cash segment or the equity segment. So that's a major, I would say, mistake which they do. So because options is a lot about timing. So the quicker you get into options and the quicker you exit, the better off you are. At the same time, as in futures, you've got the hedgers. They hedge their positions using options. If you're bullish on the market, you can buy a call option. If you're bearish on the market, you can buy a put option. At the same time, there are option strategies are also there. So you've got different types of option strategies like bull spread, bear spread. You've got calendar spreads and all that. Different strategies are there, but they are for the people who understand options in greater detail. But at the same time, options gives you the opportunity to place your position as per your view of the market. And at the same time, the options again are derivative instruments, so they are highly leveraged. So the leverage can work in your favor, can work against you. That's something which one again needs to understand.
Yeah.
So you have to understand that money management again plays a very important role in options. But at the same time, options, since they are decaying instrument, there's something called theta. So you have to define your entry, you have to define your exit. Now, many of the corporates are today using options for hedging their price risks, which is a very welcome step. So in India also we are witnessing that. So we've got all sorts of market participants because all sorts of market participants, when they come into the market, then the market really matures. Then the market really grows. So that is happening in India to a very great extent. So and I would say that is across asset classes. So be it equities, commodities, currencies. So we are seeing that. So the flip side of options is that if someone really doesn't understand much of options but goes into option writing. So option writing is the opposite of option buying. So in option buying, you buy a call option. If you're bullish on the market, you buy a put option if you're bearish on the market. Option writing is you are going short. So you are selling a call option or you are selling a put option. So never get into naked selling of options because there are people who try that and you can burn your fingers. So understanding the risks involved is very important if you're getting into the derivative instruments, be it futures or options, because then that gives you the leverage, that gives you the understanding, that gives you the confidence to really trade these markets. Or if you're a hedger, then how you can use options to hedge. Just to give an example, if you look at crude oil prices have been currently trading around more than $90 a barrel. So those who are hedging their crude risk, they would be hedging the crude when crude was at 70. So they've hedged their risk, so they are not at a disadvantage as to the current prices. But those who have not hedged their risk, they are at a serious disadvantage.
Right.
So that's the major beauty and benefit of futures and options, provided you understand them. And you can start in small ways and then you can proceed as you learn it. So if I'm talking about index options, so in index options, you have got Nifty, you've got Bank Nifty, you've got Sensex, you've got Fin Nifty, and you've got in these options, you've got your weekly contracts as well. So apart from the monthly contracts, because in futures, you've got monthly contracts. But in options, you've got weekly contracts as well as monthly contracts. So you have that advantage of trading or hedging depending upon your specific time period. So that's the major one more advantage in options.
All right, risk management it is. I'm sure that will really help our viewers. There's another question which always comes to us, which is better, futures or options?
Yeah, this is I would say, a very good question. So what happens is that futures comparatively are, I would say, more risky in nature because your risk can be unlimited. Because if there is a major up gap or a down gap and you don't have, because stop losses won't get triggered in that case. So there the risk can be unlimited in futures. But in options, if you're an option buyer, then your risk is limited to the maximum option premium that you have paid. So it can't go below zero. So that is the maximum risk that you have to, that you will endure. But if you are a writer of options and there again you are writing naked options, then again your risk is unlimited. So it would all depend on what are you trying to accomplish. One. Secondly, what happens is that majority of the traders, they are into either buying options or they are doing some strategies in options. But I would suggest that one should also look at using a combination of futures and options. So using a combination of futures and options, you can really develop some very good strategies which can help you protect against market view, against market volatility, and also will give you an advantage vis-a-vis those who are only trading futures or those who are only trading options. So I would say it would be more dependent on the person's individual choice and his or her understanding of the markets.
Okay. Taking that point forward, this brings me to my next question. Can technical analysis be used while trading derivatives?
Yeah, so technical analysis can definitely be used while trading derivative instruments, be it futures or options, because technicals helps you time the market better. And there are certain technical tools. Apart from that, you've got support zone, resistance zone. So these will help you understand where the markets are likely to turn from. Apart from that, you can also use derivatives data like the open interest data, put call ratio is there. Then you can look at whether call build-up is happening more as compared to put build-up, whether long unwinding is happening, long build-up is happening, whatever. So you've got these tools which you can supplement with technicals, and they can help you trade or identify the turning points in futures and options quite well. So definitely, I would say technical plays an important role for traders.
Now that we know what we should do, let's talk about the do's and don'ts borne in mind while trading derivatives.
Yeah, I would say that the first do is that don't take extra leverage. Meaning that you should go slow. If you are a beginner, then don't try to really hit the ball out of the stadium. Be slow. Learn as you proceed, and at the same time you need to understand risk management, you need to understand money management, you need to understand stop loss management. One. Secondly, if you're trading options, then in that case you should not go and buy deep out of money options just because they are very cheap, because many people, they just go and buy those cheap options expecting that it will be a jackpot for them. That's never a good idea, because the probability of that happening is very, very, very remote. So either you should look at, if you're trading in options, either you should look at the money or slightly out of money or slightly in the money options, not very far deep out of money options. That's the second thing. Third is, if you plan to do option strategies, then you should have a very good understanding of option strategies, option Greeks, then get into it. Just because someone else is doing something, you should not get into it. Apart from that, what you need to do is that if you are getting some suggestions from somewhere, some person, so you need to be very careful, because ultimately it is your money. So you have to be doubly sure about it. So, and there is no substitute for knowledge. So if you gain knowledge on your own, and if someone is advising you, someone is sharing some view, and you can cross check it. So that gives you a greater level of confidence to take that trade or initiate that position. So these are certain, I would say, do's and don'ts which I would definitely recommend. Lastly, I would say is that you have to, if you really want to succeed in the markets, then there is no substitute for hard work and patience. So these are two things which you need to have. And today, with I would say so much of content available across different platforms, so you can choose for yourself where you want to learn, what you want to learn, and then you can implement. So you implement at one go, and then you proceed ahead.
All right, money management, risk management, and stop loss management are all we could conclude, which people should definitely keep in mind while trading futures and options. And to wrap things, thank you so much, Amar sir, for joining us today. And we hope that you have gained a lot of valuable insights from this episode. Do not forget to click on the bell icon and subscribe to our channel so you never miss an update. Stay tuned as we have much more coming up in the next couple of episodes. Thank you so much for watching.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.